So once again, good evening, everyone. My name is Yogesh, and welcome to the final day of Investing Masterclass. And I see a lot of people are joining, and will continue to begin the session. I'm sure a lot of people are already here on time, and I see a lot of other people joining as well. So just to give you a brief, the masterclass was done for last 3-4 days, and the idea was to provide you a few awareness sessions about how financial markets work. On day one, we covered how to invest into disruption, all the companies which are capable of disrupting the industry and bring a radical change, and what sort of sectors are those. And then next day, there was Ms. Deepa who talked about the basics of investing. And then yesterday, you met Mr. Vivian, who threw some light on the technical analysis, charts, and patterns, and how it actually works. So today's session is more about understanding actually how the trade takes place in the market, and what is margin trading, what is leverage, what is short selling, because these are the terms which you will encounter while you continue to trade on your accounts. So first 30 minutes, I will be telling you about how you execute the trade, how do you put a stop loss, how do you put a take profit. And please let me know, use your chat options to tell me if there is any disturbance in the connection. I can switch off my camera later on if the disturbance is there, just to make sure that everybody can hear me properly. Please use your chat options, write yes or no or okay if you can hear me properly, if you can see my slides, if you can, if everything is smooth at your side. If there is any change to be done, please notify it using your chat options, and we'll try to rectify any network issues. Just 1 second. Okay, right. Okay, perfect. Okay, most of you have answered yes, so I'm just going to go ahead with it, but please let me know if there is any disturbance. So guys, today we are going to understand about these few terms, because when you trade, these terminologies will come across, and you should know about this, even a very basic trader. So first 30 minutes we'll discuss about how to execute the trade, how to put a stop loss, risk reward appetite, and then the remaining 30 minutes between 7:30 to 8, Mr. Vivian, who spoke about technical analysis yesterday, would do some trades live on the platform and use technicals to do that. And this is something which is not to be missed, guys. Obviously, the trades are placed every single day. If you have your demo accounts ready, you can do those also. Please make sure that any trades or any investment opportunities we are discussing today is not a recommendation for you to do it in your live accounts. Please talk to your risk consultants, financial consultants, risk managers, understand your risk appetite, and only then pursue this. These are only informative sessions, awareness sessions, so you get to know more and more information about how financial markets actually work, right? So today we are going to discuss about how actually the trade gets executed. So first of all, what you do is you need a platform. You need an online platform where you can open a trading account or a demat account, what they call it in India. If you open a trading account, once your trading account is open, you put money, you transfer money, and the money, once it reaches to your trading account, it's ready for the trading. And every trade what gets executed in a trading account is in a form of margin trading. Now this is something which is really important, guys. And if you understand what margin trading is, so any other CFD platform you trade, it is going to be as simple and as easy. So if you understand here today, it doesn't matter which CFD platform you're trading at, it is exactly going to be the same, right? So without further delay, we talk about margin trading, and I'll give you one example also. Right here. Okay. I'm going to share my screen. So meanwhile, while we do a live platform trade also, and at the same time, I explain it to you. Now, margin trading, as the name says it, It's basically a type of investment strategy, right? Or basically, when you trade, it's a strategy where you, as an investor, you borrow money from your broker to buy, say, stocks or bonds or currencies or anything. And the idea for that is to increase the efficiency of your capital. So, to put it in a very simple way, in a margin trading, you as an investor, you use your own money, but as well as you borrow some money from the broker to purchase stocks or commodities or currencies, right? And then that borrowed money, of course, the money you borrow, it comes with the interest, and obviously the interest is charged as the current interest rate. So with margin trading comes the interest charge also. Margin trading normally means using borrowed funds to purchase stocks. So while you're using your own money, you're also using money from the broker to purchase. And the idea behind margin trading is it can increase the efficiency of your capital, but also, and hear me out, this is the most important part, it can also increase the risk of losses because you are trading with borrowed money. So if you do this too much and over a limit, you can quickly lose your money also. So margin trading is only recommended to you once you understand how it works, once you understand the risk also, and you understand what is the purpose behind it, right? So if you see on this diagram right here, um, whichever amount you deposit. So if you have deposited $10,000, it does not mean that you can buy shares only worth $10,000. Your buying power increases because now you can use the money which the broker lends you to purchase it. So, for example, if I have $10,000 as an investor and I want to buy Facebook shares worth $20,000, then I can put 10,000 of my own and I can use 10,000 from my broker and buy shares worth $20,000, right? This is what margin trading means. So the idea is what you see here on the left column is the margin percentage, which means today if I have to buy, let's say, and pick any, these are just few examples of how margin percentage varies from product to product. So let's take example of 1% margin trading. How 1% margin trading works? If you have to buy, say, $20,000 worth of Facebook, you have to give only $200 from your total account, and rest will be provided to you by the broker. This is called taking a leverage of 1 is to 100 using 1% margin. Basically, by putting 200, you are buying shares worth $20,000, which is 100 times more than your capacity. Now, the question will always be that why do we do margin trading at all? So it's very simple. When you put this much money and you invest into using a smaller portion, when you get a bigger position, the profit gained on that position, if you see percentage terms, is much higher. So it's the same reason. Like when you buy a piece of land or when you buy a piece of house or a real estate, even if that real estate costs you 1 million dirhams, and if you have 1 million dirhams cash, you will still give 20% of down payment, which is a margin over here, and rest you finance it from the bank in a form of a mortgage and you pay interest over it. So basically the idea is actually same. Why you invest into a real estate using a down payment and mortgage? Because you feel that you can use your remaining 800,000 elsewhere and improve the efficiency of your capital. That's exactly why margin trading exists, right? And the process by which you do margin trading, this entire process is called leveraging your portfolio. Leveraging your portfolio. So, leveraging your portfolio means that if you have $10,000 with you and you have purchased Facebook shares of 20,000, you have leveraged your portfolio two times, right? 20,000 divided by 10, two times. So basically, the idea is very simple. When we are uh, doing a margin trade, we are not using our full money to purchase anything. There is a use of borrowed funds from the broker, and it is done to improve the efficiency of the capital. And when I say improve the efficiency of the capital, what does it actually mean? It means that if you have $10,000 and you just give $200 to buy $20,000 worth Facebook shares, so you used only 200 from your side, remaining 9,800 can be used somewhere else to buy something else to improve the efficiency of your capital. But if you do it too much over the limit, it becomes very risky for you. And today is all about understanding how these trades are executed and what you should, what you shouldn't do. Okay. So be with me. I'll do some trades on my demo account to show you that how margin trading actually works. Then followed by, I'll give you one example also. Just look at this example, all right? And tell me if you did not understand, then we'll try to take this example again and we'll also do a trade live here. So you'll be able to understand this much clearly. And please continue to ask any questions if you need, because since we are live, we'll try to answer these questions while we are doing the session. If there is a question I cannot answer, then definitely anyone from my team will get back to you and will definitely answer your question. So if you have anything, please ask me live and we'll definitely answer you the questions. Now, this is one example of how a trade could get executed using margins. Okay. Now, let's say first, and just look at the first line, for example. If you have to purchase 100 shares of $80, so one share is $80. And if you have to buy 100 shares, can you off the video so voice slide can, okay, sure, no problem. Okay, I just switched off my camera. If this makes my audio better, is it okay? Okay, perfect. Thank you so much for pointing this out. I realized there could be a issue. Perfect. I hope everybody can hear me now. Great, no worries. So now just look at the first line, okay? If you have to purchase 100 shares, every share is $80. So when you're buying 100 shares, what will be the total value? $8,000. Now imagine you just have $4,000 with you. So what do? You borrow 4,000 from your broker. And the broker is who? The broker from where you have opened your trading account with. So you have to buy $8,000 worth shares. You put 4,000 yours. You borrow 4,000 from your broker, right? Now, scenario one. If stock price goes to 85, which means you purchased at 80, and now the stock has gone up by $5, which means your total profit is 500 because you had 100 shares with you. So your profit is 500, $5 increase per share. So your profit is 500, which means the total value of your stock, which you purchased worth $8,000, is how much? 8,500. And after this, if you pay the broker their money back, you are left with 500 profit on your total original equity, which is $4,000. So now your total account value is 4,500 after you gave broker your money. Another scenario, if the stock price drops from 80 to 75, which is $5 dip, now you're in a loss of $500. If you give the broker's money back to it, you are left with 3,500. The idea is, imagine these trades with borrowed funds and without borrowed funds. Now, scenario one, if you had put all your $8,000 into this and earned a profit of 500, can anybody calculate it for me? $500 profit on an investment of 8,000. What is the percentage return? Use your chat options, guys. $500 profit on an investment of 8,000. What is the percentage return? So you invested $8,000, all yours, nothing borrowed, $8,000, all yours, made a $500 profit on it. So $500 profit on $8,000 investment. What is the percentage profit? Can anybody calculate? Okay. So I think everybody on the same note, 6.25, right? 500 divided by 8,000 into 100. Perfect. Now imagine, because you did not put all your $8,000, How much you put? You put 4,000, and rest was lent to you by the broker, which was 4,000. But your profit is 500. Now, what is $500 profit on the investment of $4,000? How much will be the percentage gain? How much will be the percentage gain? $500 profit on an investment of 4,000. Okay, perfect. Okay, okay. 12.5, 12.5, 12.5. Okay, great. 12.5 if it were on margin, excluding margin interest, of course. If you remove the margin interest, more or less. But the idea what I'm trying to give you guys is the profit amount is $500 only. But the percentage, see how it changes from 6.25 to 12.5%. Why? By employing borrowed funds, you actually increase the percentage profit. Now, hypothetically, not hypothetically, if you see theoretically, $500 profit is what you gain at all. But your capital is much more efficient when you employ the broker's money. That is why margin trading happens, to increase the efficiency of your capital. Now, there was a question here. How's the limit for margin trading determined? What happens if you overshoot it? Now, that's a very important question. And that's what we have to understand about margin trading. What happens when you overuse it? Okay. Because right now, what we are looking at, okay, I employed 50% my money, 50% broker's money. I made a profit. So my profit percentage is higher. But what happens when you use too much leverage? Now I'm going to take you to the live platform, and we are going to do a lot of these trades. Question, but you have to pay interest to the broker also. Yes, yes, exactly. So right now, what I'm the return which I'm asking, which I'm telling you is just to make you understand that how efficiently the capital can be utilized. Interest to the broker, of course. If you so interest to the broker is paid overnight. Let's say if you buy a position and keep it overnight, then the yearly interest, let's say, is 5%. So 5% of the total amount divided by 365 is what you'll be charged for one night. So it depends on how long you keep your trade open. That's the most important part. So that's why that calculation is not there. But yes, there is a leverage cost or a margin trading cost or an interest which you pay to the broker, right? Irrespective, if when you earn profit, the capital is still much more efficient than it was without adding the additional debt. Now, I'll take you to the live platform to show you what happens when you overuse your leverage. And please, this is a demo account I'm using. So do not try this in your live accounts at all. If you have a demo account, please feel free to do that. Play around with your demo accounts, but please do not do it in live accounts. Let me just quickly share this. Okay, perfect. So what you're looking at, this is again one of our platforms, Century Traders, and this is where you can see the live pricing of all the instruments. Um, as of now, as we have seen, how do we get the demo platform? Is it by requesting a demo option? Yes. So I'm sure everybody who has registered here must have received a call from one of your relationship managers. So you can call them and ask for a demo, or you can go to the website and request the demo platform. They will definitely send it to you either way. So of lately, we have seen gold prices shot up. Anybody is interested in if because I'm taking a demonstration trade anyways. So any trade you like me to execute it, gold or oil or Apple, Facebook, whatever you like. Anyone? I'll just type the instrument and try to get it and try to execute the trade. So you will be more relatable to your specific instrument. You want me to trade on gold or okay, gold right here. Gold. Wow, so many people for gold. Okay, perfect. So let me just take a trade on gold and show you how the margin trading works. So right now on this account, just look at the extreme right and you will see something called as account value. Okay, extreme right, my right. I don't know how the reflection is coming to you. Search account value. Either it is extreme, my extreme right, so it could be your extreme left. But this is what it shows, account value, which shows $10,000. Now that means this is the money which you have invested in your trading account. Okay. Now any amount, it could be 100, could be 5,000, could be 1,000, could be 1 million. Whatever you put into that account, it will reflect in your account value. Okay. So it shows $10,000. Now these are the popular products. I'm going to pick gold right here. Click on the buying price and see the order ticket. So without order ticket, you cannot execute the trade. You need to have the buying and the selling prices on your platform so you can execute the trade. Now comes another important part. I click on these menu, click on the product overview right here. Okay, I'll scroll down and show you the margin right here. If you see, margin is, if you see right here, 1%. 1%. Margin rate 1%. Note it down if you have a notebook or a diary or something. 1% margin in gold. What does it mean? It means that if I have to buy $10,000 worth of gold. So, guys, for everyone, I'm not sure how many of you track gold. Those who do, those who don't, for everybody. The price which you see right now for gold is dollar per ounce. 1 ounce is equal to $2,047 worth gold. 1 ounce is roughly 31 grams, just to make it easier. Now, if you were to purchase $10,000 worth of gold, so you can see on your platform, it will be somewhere around 4.8 ounces or 5 ounces to be rough. Now, you have $10,000 with you. Okay. You see your account value, you have $10,000. So when you write in the amount, say $10,000 right here, or let's say right here, $10,000 for example. Now, if you see, let me put 5 ounces to be exact. $10,000, it says 10,200, you have $10,000 in the amount. Now, the thing is, to buy gold, you have to click on confirm. But one thing which you have to understand is, if you see on the downside, it says estimated margin 102, which means to buy gold worth $10,200 from your $10,000 account, you just have to give $102 and you can have gold worth 10,000. Okay, I'm going to execute this trade, and then once I execute it, right here, confirm, place order. I just bought 5 ounces of gold. Okay, 5 units, 5 ounces. I close this, and now look, there is an activity which is going on here. Your $10,000, out of your $10,000, $102 is kept separate, which is your gold trade, and rest 9,890 is your available cash. You can use this cash to trade in any other commodity, in any other stock, right? But point is, if you go to account positions, you will see right here that you have purchased 5 ounces of gold, which is around $10,200, in which you are currently in a loss of $4 to $5. You see, the loss is moving because we have purchased it and we have kept this position open, right? Now, there are two things in this portfolio which you need to understand. First, that your total trade value is $10,000. Your profit and loss, which will happen to you on the gold trade, will be on the basis of $10,000, right? Just because you have blocked a margin of $102 or paid $102 doesn't mean that your loss is just restricted to 102. If gold prices go down by 50%, you will lose $5,000. You will be in a loss of $5,000. Okay. So your exposure, what we call it, is of $10,000. But how much money you have actually paid? $102. This is what a margin trading is. Now, what I'm going to do is, because right now your trade is open. When I say trade is open, which means you have started the trade, but that profit and loss will be moving up and down unless you sell it. Right now you have purchased gold, so to book a profit or loss, you have to sell it. Right now it is in a loss, so you decided to keep and not sell it. Wait till the prices goes up, right? Our buying price over here right now is how much? Our buying price will be around 2040, 2047, right? 2047 or something. Now the point is, again, So we reached to the point where we have purchased gold and we have kept it. I had $10,000. I bought gold worth $10,000. Anything now I buy, it will be more than my deposit value, right? Because I had $10,000, I bought gold worth $10,000. Yes, I have paid only 100 and used margin, but anything if I buy more will be more than my total deposit value, right? So I'm going to go and do a very aggressive trade, guys. But please do not try this in your live accounts. This is just to show you a demonstration. So what I want to tell you is, let's say I want to buy gold worth half a million, $500,000 worth gold right here, which is say 245 ounces. Okay, right here, $500,000 worth gold, $500,000 worth gold. So first things first, let's, in a layman language, you only deposited $10,000. You cannot buy anything 500 worth $500,000 in real life, right? But right now on an online platform, because you just have to use 1% of the total value, 1% is the margin. So 1% of 500,000 is $5,000. So that means I click on confirm, I place order, and I can buy gold worth 500,000. Look how quickly my loss of $5 became $300, right? Why? Because now I have 250 ounces of gold, 245 ounces plus 5 ounces. Okay. So there's the question how you are exposed to 10,000 if you have only invested one or two. So that's a good question. How I'm exposed to $10,000, like for example, now how I am exposed to more than $500,000 worth of gold, because my exposure value is the value on which I have the risk, because the amount of gold which I have purchased is worth half a million, or in the previous case, it was $10,000. Yes, I only booked a margin of $102, but my profit and loss is not just restricted to 102. That is just the amount which I have paid as a booking amount to take the trade worth 10,000. Okay, so this is a very important point. So please understand this. Your exposure value, your profit and loss ability is on the actual purchase exposure. So when I have purchased $500,000 worth of gold, if I have blocked only $5,000 worth, $5,000 worth margin, it doesn't mean my loss is restricted to 5,000. Tomorrow, if market declines by 10%, $500,000 worth of gold, 10% decline, my loss will be 50,000. Okay. So this is something which you should understand, guys. This is a really important point. It doesn't matter how much margin you block, the worth of gold you have purchased, your profit and loss will be on that particular amount. So if you see right now, I have a loss of $600 and I have gold which I have purchased. If you see right here, if you see, it is 512,462. $500,000 worth gold, and I have just given $5,000 to purchase it, right? So margin is 5,000, but my exposure value is 512. Now coming back to the question, you have understood that you are just paying a percentage of the total value from your account, but your exposure is on the full value. So it means that tomorrow, if gold prices drop by 50%, your loss will be $250,000 because your gold position is worth 500,000. If gold dips by 50%, then your value will be 250K, which means your loss will be 250,000. But you do not have 250,000. How much money you have? You have just $10,000, right? So in that case, what happens? The moment gold price starts dropping, and the moment price starts coming down, and it reaches to the point, to the money which you have deposited, when the loss reaches closer to the $10,000, which is your actual deposit amount, your broker gives you a notification, gives you a margin call that you need to add more money if you want to continue hold this trade of gold worth 500,000. If you add more money, you survive. If you don't add more money, then your $10,000 becomes zero and you are out of this trade. The broker liquidates your position to prevent you from losing extra than what you have deposited. You understand? Now you understand that how you are able to take such a heavy position by using a smaller margin, because the moment your loss reaches the total loss on the position, the moment it reaches to the account value, the broker closes and liquidates the trade. The biggest risk is higher the leverage you take, higher the position you take, higher are the chances of you making a lot of money or losing your money real quick. So I'm going to give you again a live example. Again, guys, it's a very aggressive trade, not recommended. I'm just giving you a live example to show you the risk part of it. So if you see here, right now I still have $4,300 left in my account because 5,000 is already blocked as a margin. So what I'm going to do is, let's say US 30, for example, US 30 cash. I'm going to buy here, say $200,000 worth, or let's buy 10 units. Now 10 units of US 30, it means, yeah, 10 units of US 30 are worth $330,000. $330,000. But same 1% margin, so only $3,300 needed, and you have 4,300 in your account. So what I'm going to do, confirm place order. You just bought a US stock market index of worth 330. Now your total portfolio value is $800,000. Your margin 1% from your 10,000 is blocked 8,000 already. Now you are left with hardly $1,000, right? Because you're losing $500 already in the portfolio. So the moment your available cash becomes zero or negative, you receive a margin call, basically a notification. If you add more money, you can continue to hold your trade. But if you don't add more money, the moment loss nears your total deposit value, automatically all your trades will be sold in the losses, and you will quickly lose your money if you take such aggressive trades. Right? So, guys, this is how margin trading works, and it's a very, very important thing. Another thing before we move to Vivian and understand about technicals, there is something called short selling. And short selling is a very, very popular tool. Let me bring you back to the presentation right here. See, so another tool which is there is short selling, and short selling is also these two things. If you understand, any platform, any broker you can easily work with, because these two are the most important things even in the trading. So you understood margin trading. Now you have to understand short selling. What is exactly short selling? Short selling is, to explain in the most simplest way. Basically, it's a type of strategy where you as an investor are expecting the price of something to go down. And to capitalize on that fall, what you do is you borrow that particular stock which you are expecting will fall down. You borrow that stock from your broker and immediately sell it in the open market. So if you think McDonald's stock prices are going to go down, and McDonald's price it is at $200. So you borrow McDonald's shares and immediately sell it in the market for $200. And the moment price drops to say 190, so the $200 you sold it for $200, so hypothetically your account is plus 200, right? Because you sold it. And the moment price drops to 190, from the 200 you pay 190, buy the stock back, give it back to the broker, and keep the $10 as a difference. Exactly what I just told you, exactly how it actually works. So the important question will be, how can I sell something which I don't have? You borrow from your broker and you sell it in the live market. How you do it? With a click of a button. Okay, so I'm going to show you another example. Let me just quickly close one trade so I can give you an example, because I don't have enough margin on this one. So confirm close position. Let me take you back to the platform and I'll show you how the short selling is done. Right? Just 1 second. Yeah. Okay. Now, if you look at it, I closed one position which I took. So now I'm going to tell you how short selling works. How short selling works, let's say any stock, and I'm going to take, say, Apple here, for example. And it can be done in commodities, it can be done in index, it can be done in stock, anything. I'm just going to give you an example of Apple. So let's say Apple price, the selling price. So earlier what I did, I clicked on buy because I wanted to buy because I was expecting prices to go up. Now I'm going to click on selling price. Selling price means now I am borrowing this stock from the broker and selling it live in the market. So let's say I want to sell 100 shares of Apple at a price of 165. Okay, 165. Now if I sell it at 165 and price comes down to 160, I can buy it back at 160 and give my stock to the broker, okay, and keep the price difference. So I'm just going to quickly, and exactly the same thing. You short sell, you buy. In either case, you block a margin. It exactly works in the same way. So you see, I'm short selling right now. Everybody look it on the screen. 100 shares, sell, confirm, place order, and it's done. So now if you see, my first position right here is gold, which shows with blue buy, and second is Apple, which shows sell or short sell. What is short sell? It means that I am expecting Apple prices to fall. So what I did, I borrowed that stock from the broker, sold it live in the market, and now if price drops to 160, I'll buy the stock back. But when I buy it back, I'm not going to keep it with me. It automatically will go to the broker, but the price difference will come to me. So a lot of people do online trading also for the same reason, that not only they can trade on margins, but also they can take advantage of the falling prices. Short selling can be done on stocks, on gold, crude oil, silver, platinum, palladium, Dow Jones, German index, index, any currency, even on cryptocurrencies, you can do short selling if you are expecting prices to fall, right? There is no limit. I think a lot of investors who do this in India, there is a limit of a day, that after that particular day you have to close your trade. There is no urgency over here. As much margin you have in your account, you can continue to short sell. There is no forced closure unless you have a margin call or a liquidation. Correct? Anybody has any questions on short selling, guys? Any short selling, or if you want me to take another example, anyone has any questions? It's really important. If you have any questions, because even when you are doing your technical analysis, you are not just buying every time. Now, I mean, in a while when Vivian will come, he will tell you that how many times the market are trending downwards, so you can actually short sell and take advantage of the falling prices, right? So that is also something which is possible. Okay, now just 1 second. Any questions, guys? If you have any questions, please continue to write. And I'm definitely okay right here. Okay. Um, okay. How do I sell without owning a stock? Okay. Missed yesterday's session. Where can I find it? It's not showing on the website, on the YouTube. So once these sessions are over, YouTube recordings will be recorded also. What happens if the price goes? Okay. So can you do one more example? Yes, I can definitely do one more example. What happens if the price goes up and you don't have money to pay? So in the short selling case, because when you buy gold, let's say I bought gold, I was expecting price to go up, right? So I can make profit. But if it goes down, then I make a loss. In a short selling transaction, I expect price to fall. But if the price goes up and continues to go up, then which means that my loss continues to increase. So eventually I will get a margin call there. And if I do not add up the margin, I will be liquidated. Exactly how it happens in a buying position, it will happen in the selling position also. So my loss in a short selling position is when where the price goes up. So that's where my prediction will be wrong. That if I short sell Apple shares and tomorrow if Apple shares go up, and I am not able to put margin money, and if it continues to go up and my losses continue to go up near my deposit amount, so I have to either put margin money. If I cannot, then my positions will be liquidated, and I will lose all my money, right? How do I sell without owning a stock? Again, very good question. How can you sell without owning a stock? You borrow it from your broker. So when you click on that button and click on sell and do this, every broker has a certain inventory with them. So whichever stock you want to short sell or commodity you want to short sell, you borrow it from the broker's inventory and sell it. That's how you sell any stock without owning it. So I'm just going to take another example before I call Vivian here. So this is Apple. Let's say I'll take example of okay, let's say Facebook, for example. So Facebook right here. Now see, the Facebook buying price is 238, but the selling price is 237. Okay. Now when I'm clicking on sell, I'm writing say 50 shares of Facebook. Margin will be $3,000, but I don't have enough margin. I have only 1,800. So let's say I'll just do with 10 shares. 10 shares of Facebook, I want to short sell. Margin needed around $600. Now, when I write 10 units Facebook and I click on sell, this means I am borrowing it from the broker's inventory. I click on confirm, place order, and I just short sell Facebook also. You see, this is orange. Both of them are orange, which means if Facebook shares drop, if the price drops, I will make a profit. But if the price go up, I will make a loss. Right? Exactly how short selling works. And I'll give you an example also. If I have to book my loss here, like this is my $5 loss, right? So to book a loss or to book a profit, I have to buy these shares back and give it back to the broker. How this will happen? In a simple click on cross. So now I'm buying it back, but the moment I'm buying it back, confirm, close, my loss gets deducted, my margin comes back, and the stock automatically went back to the broker. It's not that when I buy back the stock, I keep it with my portfolio. It's just a reverse transaction, how you buy and sell. In this case, you short sell and then buy. Correct? Again, guys, I'm very much open if you want to come to the office for a one-on-one session, sit and understand about this, because this is a very basic thing. Short selling is not something which has started today. It's been a very important part of the online trading platforms. And if you search short selling on Google or anywhere, you will see numerous examples, and a lot of these platforms they do it. Right now, very quickly, I would like to invite Mr. Vivian, who is one of our chief market analysts, one of the best consultants as well, and he has done a lot of technical analysis. And he conducted one session yesterday where he threw some light on how technicals actually work. And today, since we promised people a live trading session, few trades I have executed here, but these are the trades which I just wanted to show you. Vivian is going to tell you that how you can actually use technicals to execute a trade, to suggest if it's a buy or it's a short sell. Okay, one question also. Yes, Vivian. We'll take this question later. Yes.
Hi, thank
Hi.
you.
You. Yeah.
Hi. Good evening, everyone. I hope you all have been enjoying the session. And those of you who had joined me yesterday as well, we discussed a lot of technical tools that we can use to identify opportunities in the market. Please feel free to continue writing your questions. We will try and answer all the questions during the session. And if later, if any of your questions have been missed, you can always reach out to us and we will definitely get back to you. I'll be sharing my screen now, and we'll look at a couple of trading opportunities if we find any on the technical tools that we discussed about yesterday. At the same time, let's look at how we use our trend lines, our support, resistance. I will show you a couple of tricks that you can use so that you are not biased in terms of drawing your trend lines or support and resistance. Let me just share my screen here. Have everyone who have joined right now, were you all available yesterday and were you there attending the session? If you haven't attended my yesterday's session, do not worry. I will still try and cover most of the basics while I'm showing on the live chart. All right. Just to do a very quick recap, can you all just quickly write in what you all remember from yesterday's session in the meanwhile? All right. Okay. Till you guys can continue writing to me. Let's start with the basic support and resistance, and I will show you a trick how you can get good support resistance without being too biased. Now we discussed about different types of charting. The simple one, which is the line chart, and then you had your candlestick chart. Now, whenever what I told you yesterday is whenever you're trying to identify support, resistance, or a trend, a line chart would always give you a clearer picture. I'm just going to change this to a line chart. Now you can see this is a line chart, and we should always remember what time frame we are looking at. If you are looking at a monthly time frame, that means you are looking at a very long horizon. As you can see, the monthly time frame shows you all the way from 1995 till date. But at the same time, the same can be applied on a 30-minute chart, where you will see market momentum that is happening every 30 minutes. If I go to, sorry, this is a spread. Let me go to line chart. Yes. Yeah. So yes, you have written ATR, RSI, support resistance. Yes, perfect. And this is on a 30-minute time frame. If I go to my candlestick pattern here, each candle represents a 30-minute time frame moment, right? On the candlesticks, we had discussed how the body is formed. The body represents the open and the close. The tail represents the high. Just to see a quick one, let's just look at a 10-second candlestick pattern. So every 10 seconds, you would see a new candle that forms, right? So there's a candle that is live right now. You can see it move. After 10 seconds, it goes to the next candle. Now you can see this particular candle is moving up, hence it's green. Let's see what happens in the next 10 seconds. Okay, in that previous 10 seconds, the price opened lower, closed on the higher end, and hence it's a green candle. So you get the idea of how the candlestick works. Now, depending on the time frame that you choose, each candle represents the movement for that particular time frame. In this case, 30 minutes. For the last 30 minutes, this was the move that has happened. This particular 30 minutes, right now, we have another 13 more minutes to go. So this candle will close based on where the prices close. Either it's going to be a red candle or it's going to be a green candle. It could be closing way lower over here. It could close all the way high as here, or probably it might just trade in this range for the next 15 minutes, and the candle might close here. All right. Now let's get on to the interesting part of it. Here's one trick that I have learned through experience. So I thought I would share that with you. Now, how do you draw your support and resistance? We discussed yesterday. We find sideway moving market, or you look at trends. So in this case, you see there's a trend that is happening here. You connect your tops, you connect your bottoms. Now if there is more than 3 to 4 times the level where it has taken resistance and support, it becomes a strong support, strong resistance, right? Now let's go to a very simple way but a very effective way of understanding support or drawing your support and resistance lines. Even if you're a short-term trader, this will help you. You can pretty much do the exercise on any time frame that you may choose, but I'm going to start with the monthly time frame, and I'm going to the line chart. Right now I am on a monthly time frame. How do I draw my support and resistance? Very simple. With a line chart, you can choose all the tops, you can choose all the bottoms. Oops, that was the wrong. Yeah, you can choose the bottom. Here's a top again. Here is a top. Here is a top. I'm just going to be drawing few lines only. We don't need to do this entire exercise for all of it. But once you start trading, I would always recommend that you do it and save your charts so that every time you come back onto the chart, your support resistance is always available for you to look at. Now of course, now I'm looking at a monthly time frame. Now on my monthly time frame, I can see a lot of supports and resistance that is here. Now if I'm looking at a shorter time frame, let's go to a 30-minute chart. Right now in my 30-minute chart, I go back to my candlesticks. Now can you see the pattern? Okay, let me make this 1 hour chart. If you notice the price action that has happened on these levels, you see, the market has taken resistance around these prices. Let me increase my font. Yeah, yeah, you can see the price. at 4164 has been quite a strong resistance. So if you're a short-term trader or if you are looking at something on a little longer duration as well, you understand that every time it goes to 4164, there are good chances it will drop. Now, on what basis are these drops happening? It's because of the psychology that I told you, spoke to you all about yesterday. Why a support and resistance usually reacts in a certain way is because a lot of sellers, short selling, which Yogesh just spoke to you about, a lot of short sellers would look to sell at higher prices so that when the market drops, they would like to gain on it. On the other hand, you will also have people who have bought at the lower prices on supports, and when it goes back to a desired level, they would look at booking their profit. Now, again, we discussed about how do you identify where to book your profits and where to keep your stop losses. We'll get into that when we start using the ATR. Right now, this support and resistance, what I had drawn on monthly chart, right? This was a very long time frame. You can see, although I'm going into a shorter time frame of 30 minutes, you can see price action happening within this support and resistance. So if you're a short-term trader, you would always watch out for the support resistance here and then take advantage of it. You can do the same exercise, go to your line chart, and you can do a similar one on a daily chart. Now, why I would avoid doing a daily chart is for this example is because we have a lot of support and resistance. But for example's sake, I'm just going to select few of them. Okay, you see there was a high. Any doubts with how to draw the support and resistance? Please let me know. I'm just going to quickly draw. I'll make it bigger so you all can see how I'm picking. So I'm just picking all the tops and I'm picking all the bottoms, right, of the price action. Let's not go way deep into it. Let's just look at a couple of trades here. All right, now I do the same thing on a daily chart. Now, if I go back to my 30-minute chart, now let's look at the price action here. I'm just going to remove the grid line here. It's more easier. Oops. I'm sorry. Let me just put this chart back on. Yeah. So let me go back to my candlesticks. Perfect. Now, based on the support and resistance, we looked at it. There is a support at the current levels. I'm looking at a 30-minute time frame. That means my desired result would happen in the next 30 minutes to probably even 3 to 4 hours, depending on the market momentum. If I'm looking at a 30-minute time frame, I told you we are looking at a short-term trade, probably an intraday trade. Now let's look at this support, which is at 4050. So I would probably decide on taking a trade here. But like I mentioned to you, you can use your RSI and ATR to give you few more indications. Let's look at what RSI is saying. Now you see we discussed that RSI every time it's below 30%, uh, it is at oversold region. So we have one confirmation that this particular area is a good level for markets to bounce back up. Now we are going to combine that with my ATR. All right. Can anybody tell us what ATR helps us with quickly? No worries. I think since we are running short in time, let me just explain ATR. So, what I explained yesterday, ATR lets us know or helps us to identify how many dollars a particular instrument, in this case, we are looking at S&P 500, will move in a given time frame. And the time frame that we are looking at over here is 30 minutes. So let's look at a 30-minute time frame. My ATR says it can move about $11 every 30 minutes. So that's great. Now let's look at our support. So now we have a support over here. In the case where, in this case, we are going to be taking a buy position based on RSI being oversold and also a support seeing back down. So let's say I will not get into the leverage and the margin side of it. Yogesh has already explained that to you. In this particular example, I'm just going to be taking a 10 unit trade, which is roughly about $40,000 with a $10,000 account value. Now, now we identified our entry point, right? Now we need to see how much take profit. So there are two take profits that you can look at. The first one on a short term here, because this would act as a resistance. But if you want a little bigger profit, you can also aim to get on the higher end. That's at 4088. Now, stop loss, you can keep it below the resistance. We're going to be buying it here. Stop loss can be below, sorry, below the support, below the next support, so that you give it enough of space. All right. Now, this is one way of keeping your stop loss. The other way of keeping your stop loss is by looking at the ATR. You know, on an average, $11 moves every 30 minutes. So you can always look at keeping a stop loss about $10 or $11 away from your entry price. For this example, since the price has not yet reached, I'm still going to go ahead and take this trade. Any doubts or questions with the stop loss and take profit, please let me know. I'm going to place this order. Let me just take it at the market. So you're risking about $230 to make about $340. And there we go. Here's your trade based on your support, second confirmation on RSI, and of course, you used your ATR to see how much of gap you need to give or how much of distance you need to give to keep your stop loss. Because you keep a stop loss very close by, could also turn out to be dangerous because it can come down, it might as well trigger your stop loss and it goes back up. So when you choose your stop loss, always make sure you keep your stop loss at a distance where it is more, where it's less likely to trigger. But at the same time, don't keep it that far away that the trade is not worth taking. I'm just going to close all of my indicators here. Now you see my trade. You have taken a trade based on support. You will see previously there has been support where the prices have bounced back. If I just look at these levels, you see a good upside movement over here. You see that your stop loss is below the resistance, which could act as a support right now. So you have enough space for your stop loss. At the same time, you have kept a decent enough take profit for yourself, right? So this is just one of the most basic way that you can start practicing on your own, by drawing your support and resistance. And once you get used to identifying support resistance, you start using your other indicators. In this example, in the example that I gave you yesterday was on RSI to identify oversold and overbought regions. Remember that I also told you, just because RSI is at oversold, that does not mean the market has to bounce back up. There are oversold regions, for example, here, where it came to a oversold region and it continued dropping. So stop loss is always a must, and you always take your trades based on pure logic that is given by the technical tools. So for us not to be biased, the best way to draw your support and resistance is by going to your line chart and taking a higher time frame. You can also do a weekly time frame and start marking out all the tops and bottoms. Why are these tops and bottoms support and resistance? Is very self-explanatory. Every time it has come down to these levels, it has bounced back up, so that makes it a strong support. At the same time, every time it has made these peaks, it has dropped back down, so that particular area is acting as resistance. So this is one way to add your support and resistance. One more thing that we discussed about yesterday is identifying chart patterns. Let's look at one on a monthly time frame. I think we did see this yesterday. I'll just show that to you again. While I'm showing this to you, please, if you notice any other chart pattern that is there very visible, please write in the chat. There is one very obvious one that is actually forming, but let's look at the one that I showed you in my example yesterday. Quickly, we saw head and shoulder. I think it's very easy to identify here. This is the shoulder, this was the head, and the second shoulder. Just gonna make this different color. Yeah. So remember what we discussed, that once a head and shoulder pattern has formed and the neckline breaks, right? Once the neckline breaks, the neckline is basically where the shoulder, where the head actually ends and the shoulder begins. Once the neckline breaks, you can expect the price of the market to drop down as low as the neck to your head, right? The distance of this, which is roughly about $475, or in percentage terms, about 10%, you can expect a 10% drop once the neckline breaks. So in this case, how would a trader take a trade? He would wait for the neckline to break, or since you're looking at a monthly time frame, probably you're not trading, you might be looking at a little longer duration to sell and hold, in this case short selling. uh, Stop loss, you can keep it above your shoulder. Let me just make this red. All right, and your take profit would be back down over here by at 10%. So in the case of risk reward, you'll be risking about 6% to make a 10 to 12% gain, so which is about 1 is to 2 again, right? Now, a small challenge to all of you all over here. Can you identify any other pattern? We looked at head and shoulder. We spoke about reverse head and shoulder. Can you all see a reverse head and shoulder anywhere? Anyone? All right, no problem. I'll show you a reverse head and shoulder. Can you see this pattern here that is forming? So in this case, we see a reverse head and shoulder, and where is a neckline, the neckline here, right? Now once the neckline breaks, you can expect the prices to start moving up. So here we see it's not a straight neckline. I would draw the connecting dots here. Yep. So this is your neckline extended to the right. Now you can see it has broken above the neckline. In this case, one could expect the prices of SPX 500 to climb up, but how much can it climb up? Based on the neckline over here, neckline to the head, about 14% is what you can expect SPX to move. Now, of course, now this 14% is not going to happen over a period of 1 month, or sorry, or a period of a day or a week. Since you're looking at a monthly time frame, this 13% move could probably take at least 3 to 4 months to happen, until and unless there is any news that can fasten the process. At the same time, please remember, all of these patterns also need to have stop losses. Now, in the case where it comes back below the neckline, let's say the price action fails, or the pattern fails, and not all patterns are 100 percent will have a 100% hit ratio, I would say. There are patterns which fail often, and hence we need the stop losses. Now in the case where it drops back down, this particular pattern fails and the prices could drop further, or the prices could again go back up, and hence in this case, someone who is looking to take advantage of a head and shoulder pattern would look at taking a position with a stop loss below the shoulder, similarly what we did here, and of course the take profit on the upside roughly over here. So if someone has to take a 10 unit trade again, which is $40,000 investment, you'd be looking at making about $5,000 as a profit, with a risk of $2,000 on the downside. Now you could always minimize your risk. You can see support and resistance. In this case, there is small support over here where the market has bounced back up sharply, you can reduce your risk by even keeping your stop loss a little close by to your entry price. Any questions so far?
I think Vivin, there was one question regarding the buying because when you initiated the conversation with the candles, so there was one question: is it good to buy at normally red candle, or is it something like,
Okay.
yeah?
Yes, yes, I saw that question. Thank you, Yogesh. Candlesticks. So there are people who trade based on candlesticks itself. You usually buy a particular product when you see the prices lower. So most of the time, when you are buying, you would end up buying it when it is technically a red candle. But if you're a cautious trader or if you're a cautious investor, you could always wait for two or three candlesticks to show a reversal signal, minimum two to three. So that would definitely be a green candle. Let's say, for example, in this case, I see a support down at this level. Just for example's sake, let's say this was a very good solid support and I want to buy it at this particular price. So although this is a red candle, I will still go ahead and buy it. Reason being, it I've seen a support over here, and let's say my RSI is also giving me a oversold signal, so that we can expect the prices to go back up. But however, let's say if I want to be a cautious trader and do not want to jump in directly at the lower level of the support, I can always wait for two green candlesticks and then enter into the market. So it comes down to how you want to interpret each candlestick. Each candlestick has a story behind it. You can probably we'll do a session only on candlesticks in the future. Each candlesticks has a story that it says. Because of the momentum, like in this particular case, you will see a very simple example is the body is the buy, open and the close, but you could see the prices moved all the way as low as this price and the prices has moved back up as high as this price, but it eventually closed where it opened. So this particular candle has a story to tell by itself, because you can see the buyers and sellers, battling out which direction they want to enter, and eventually in that 30-minute time frame, they stopped at where the price pretty much opened. Right, this particular candle tells you a very clear signal that the sellers are dominating in the market, and hence if the markets are dropping, I would be cautious of a very big red candle. So each candle definitely has a story to it. But if you want to buy, you don't have to necessarily always have to wait for a green candle to buy it. But if you want to be a little more cautious, you can always wait for one or two more candles to give you a confirmation and then enter. But that has its own downside, because if we did not enter on this red candle, these two candles basically went back up till the resistance. So hence I would miss the trade as well. All right. So I think in
Perfect, perfect, Vivin. Yeah.
and in terms of support resistance, again, these are just foundational courses. We can go more in depth. Yogesh is always there. If you need any other additional information, please do reach out to us. And you can always come down to our office. Yogesh is always available, and I'm available as well for any technical training.
So, Vivian, one more thing before we leave this. So, just to bring you back on the current market scenario, yesterday we saw that Fed has done another rate hike by 25 basis points, and today European Central Bank also. So, just to
Correct.
give our attendees a slight understanding of what the markets look like gold, euro, pound, what are we looking S&P at? Um, is it a short-term buy or a sell, or are there levels which we can capitalize on?
Sure, Yogesh. So now that we know that the interest rate is being raised only to control inflation, so that is just one side of the story. But on the other side of the story, what we need to realize is, if the interest rates are high, it becomes very difficult I mean, it becomes very expensive to borrow money. So businesses, they tend to struggle because the borrowing cost to expand their business is higher, and hence because of high interest rate or borrowing cost, Other businesses would either look at stopping in their expansion, or they could also look at a lot of layoffs for their company to sustain the current market conditions and to still be profitable in their business. But in terms of S&P 500, I think like what Jerome Powell said in a statement yesterday, it all depends on the data that is coming out, the economic data. If the employment is still not as bad and people still have the spending power, they could very much look at getting the inflation under control. And if the inflation comes under control, they can always reverse the interest rate hikes and slowly start decreasing it, which definitely will be a boost to most of the technology companies, at least in my opinion. But in the
Yeah,
short term,
so
yeah.
this Vivian, sorry to interrupt. Yeah, this was actually one of the questions asked
Mhm.
that in a high interest rate environment, a lot of investors have ditched the tech stocks and moved towards value last year. But then we
Correct.
have seen Nasdaq coming down by 35%. We have seen a lot of good tech companies coming down. So,
Yes.
did you feel this could be the year where investors can start building positions on for the tech stocks?
Definitely, Yogesh, because especially the big tech companies like Apple, Amazon, Alphabet, these are companies that if you're getting a dip to buy in, it's a golden opportunity. Because if you look at the performance of Apple itself, let me just open here on my chart. Right, every dip was a buying opportunity, although the future looks a little shaky at this point in time. But over the years, if you're looking at investing in big companies like Apple, Amazon, you would always reap the benefit of it every time you buy it at a drop in the market. Of course, every drop is an opportunity for especially tech companies.
Great. And gold has surprised everyone. I mean, I wouldn't say surprised that the trend looked pretty on the bullish side, but after the rate hike, we saw
Mhm.
a big jump in the gold prices. Now, tomorrow being the non-farm payroll, if I'm not wrong, and one of the key important employment data,
Yeah.
we can expect a lot of volatility in gold, right? What is the resistance for gold like at this point? Is it about to break something, or is it at the resistance point?
Gold surprisingly has been doing really well, definitely because of a lot of uncertainty in the market. People would like to park their money in safe haven, and hence gold always shines when there is a lot of uncertainty or any geopolitical tension in the market. Now, in this case, gold has, if you can see my chart, it has come to a very crucial level. Over here, let me just mark out the levels so you can see the levels as well. Can you see my chart? Yeah. All right. So a very crucial level on gold is about 2080. Now a break above 2080 could pretty much push gold much more higher, provided because of all the uncertainty that is surrounding the markets. Now, if eventually dollar starts weakening, gold should ideally break above 2080. But however, if 2080, since it is a strong resistance, since we spoke about support and resistance, we should always be cautious at this levels, because if there is a downtrend that eventually picks back up, gold could go down further quite drastically as well. But we are in a very crucial and I think in one of history in making, if gold breaks about 2080, most of the banks have anticipated gold could go to 2150 to 2200.
Okay, that's going to be very revolutionary. I mean, last 10, 12 years is, I mean,
Yeah.
over a period of time, we haven't seen gold reaching to that point. So I think important news tomorrow. And thank you so much, Vivian. Thank you for your insights and analysis. I think more we understand technicals or fundamentals, it will never be enough. But the good part is we always have to continue hit and trials. We should continue to trade in the demo accounts, see what strategies work for us and what not. At the end of the day, markets are always tricky and volatile, and it's really good that you also told us to put stop losses with every trade. I think that's one of the most important things, whichever strategy you apply to. So
Yes.
that's really great. So everyone, thank you so much, and I'm sure a lot of you will have a lot of questions, if not now, then later on. And will be definitely available at our place of work, or if you want to, whenever you feel that you want to connect over Zoom, we are available for these sessions, whether it's technicals or fundamentals or discussing any sort of portfolios. And this is what Century does almost every week, every 2 weeks. We try to do a lot of awareness sessions. Vivian does a lot of technical webinars on Fibonacci's and advanced technical analysis, whereas I try to do a lot of sessions on different topics related to investment opportunities, navigating into volatilities during the volatile markets. And we'll continue to do these sessions. And thank you so much for your continuous support in this entire masterclass. Last 4 days have been phenomenal. Each and every speaker he would have come, and you have been a very interactive audience. And I'm sure with all these questions coming in, will definitely be able to take the right decisions. One last question, which is here: which market is best and safe to invest if you're very new to the market? So very good question also, and a lot of investors have this question. Um, to begin with, if if you're very new to market, and more than that, you have to understand what your risk appetite is. If you're a very conservative investor, you want to be away from a lot of fluctuations and volatility. Initially, your exposure to the stocks should be restricted to those companies which are very less fluctuating and gives you a fixed dividend also. So in that case, what happens is, if you buy a stock like Coca-Cola or AT&T or McDonald's or Walmart sort of companies, which are less fluctuating, which are less volatile, but at the same time it gives you a fixed dividend, a fixed income, I think that could be a good start. Because of course at this point of time, because bonds have been available at a discounted price, and with interest rates coming to a peak eventually, could be a good idea for bond prices to go up. So yes, bonds will always be in your portfolio as one of the most conservative instruments, but within stocks, I think you should be definitely away from cryptocurrencies or forex if you are new to the market. um, be away from the technological companies because they move a lot, but you can still ahead and add a few quality names like Vivian said, Amazons and Apples to your portfolio. But other than that, the best way is, because US is one of the largest market. Yes, good quality companies in US, but at the same time, some emerging markets like India, for example, I don't think it will be a bad idea to have a good exposure in Indian stocks also, but the quality names. Again, as I said, stick to the quality at this time, because these times are really crucial. The experimental stocks, or the stocks which are growth stocks, which have good potential for another 5 6 years, uh, that could be a big risk. I mean, big risk, big rewards. But you want to be on the safer side, I think be away from commodities too much. Do not get involved yourself into regular trading. And if you're doing that, please take a very minimal leverage and keep your stop losses, as Vivian says. But add your portfolio towards good quality names where you can get a fixed dividend also, and the volatility of the fluctuations in your portfolio are less. And also, regular trading is not needed if you are very new to the market. Just take positional trades, situational trades. Look, if it's a very good support, a weekly support, you can enter. But please do it with a stop loss. And as far as commodities are concerned, instead of taking a direct exposure in gold as a commodity, if you want to take exposure in commodities, buy gold related funds and ETFs. There are a lot of them available. As far as index trading is concerned, if you want to buy and sell index, but you are very new to the market, rather than taking a direct exposure in an index, buy a fund, Vanguard S&P 500 fund or a triple Q Nasdaq fund, which will be less volatile, and at the same time you will get the exposure of the market. So, once you start understanding how this works, you can involve yourself into day trading. But please understand this: if you're very new to the market, be away from cryptos, be away from forex, be away from too much speculation. Do not trade every day. You want exposure into commodities or indices, do it through funds and ETFs, which will be less volatile. And from the equity side, growth or tech companies should be avoided to the new people. More exposure towards defensive sector. And when I say defensive, which means that sector which is kind of recession proof, basically Johnson and Johnson or Walmart or Coca-Cola type stocks, which gives you dividend and move less. So I think that should be the point. And the question: will you issue the participant certificate to us? Absolutely, absolutely. Once we have the entire list of everyone, we'll have participant certificates also issued to you. Do you have index fund in US and India? Definitely, definitely. We have US index funds also. As I said, there are a lot of index funds: Vanguard, S&P 500, Triple Q, Nasdaq, SPDR, SPX 500 funds, and so we have for India also from iShares and BlackRock. So definitely, absolutely, we'll reach you out on this. And please, as I said, let us know if you want any sort of understanding or training from our side. Whether a client or not, this is something which we do for everyone. You can come to our office. Please treat this place as a second home. So whatever is convenient to you, a session over Zoom or coming to the office, we are definitely available. Just book your appointment a day prior, and we'll definitely be sitting with you and assisting you with this. So we have reached to the end of the masterclass, and thank you so much, everyone. I think we have shared a lot of valuable thoughts over here, and thanks to all the speakers, Vivian and Deepa. Deepa is not here today, but Vivian, thank you so much for being there with us and sharing your insights about technicals and the current market scenario. We'll see you next week with different topics, and we'll continue these sessions. If you like these sessions, please go on Google reviews and review Century Financials. Share your feedback with us and encourage us to do more and more sessions in the coming week. Will I be receiving a certificate if I couldn't attend yesterday's session? For sure, not a problem. Definitely not a problem. If you have even attended one session, definitely we'll put your name there. So do not worry about it. So, guys, thank you so much. You have a great night, and tomorrow is the last day of the week. So, I'm assuming everybody has worked really hard. So, one more day to go, and then a good weekend coming towards you. I wish you nothing but a very good and healthy week. All the health, wealth, and happiness to everyone here. And my name is Yogesh. Thank you so much for being a part of this session. And we'll see you next week with a different topic, with a different session. And till then, have a good night.